Welcome to this explainer. Today, we're putting on our sell-side equity analyst hats to produce a rigorous, fundamental valuation of Meritage homes trading under the ticker MTH. If you love digging into the financial mechanics of a company to uncover its true intrinsic value, well, you are definitely in the right place. We're going to look past the market noise and rely entirely on hard data to build a really comprehensive valuation profile.
Okay, let's just dive right into it. The stock is currently sitting at a last close price of $64.12, but out in the market, a price is just a number until you give it context, right? Our job today is to determine if that $64 price tag is a brilliant bargain, fairly valued equity, or a value trap just waiting to catch unsuspecting investors.
To figure this out, we're going to walk methodically through the Analyst Valuation Toolkit. We'll look at the core investment thesis, tackle absolute and relative models, openly discuss our structural limitations, and explicitly log our assumptions along the way.
All right, Section 1, the MTH investment thesis. I like to call this a tale of two values, and you'll see exactly why in a second. When you run a fundamental valuation, you usually expect your models to cluster around a central logical figure, but with Meritage Homes, we get a stark, almost startling discrepancy right out of the gate.
So there's this massive disconnect staring right at us. We have a current market price of around $64 sitting against a calculated discounted cash flow fair value of just $29.02. That represents a negative 121% margin of safety. Honestly, if you just looked at this one metric, you'd immediately conclude the stock is wildly overvalued and run for the hills. But, as analysts, we don't just take one output at face value. We have to interrogate it.
Which brings us to Section 2. Let's really stress test these absolute valuation models, starting with the bedrock of finance, the discounted cash flow, or DCF.
Now, standard DCF methodology is elegantly simple in theory, but man, is it sensitive in practice. You project out the company's free cash flows, usually 5 to 10 years out, determine a terminal value, and then discount everything back to present value using the weighted average cost of capital. But the whole entire model hinges on one absolutely crucial thing: predictable cash flows. And here is where things get wild. The trailing 12-month free cash flow growth is explosive, up over 162%, generating roughly $237 million. But look at the 3-year average CAGR. It's actually negative 21.3%. With that kind of massive historical volatility, trying to forecast a steady terminal growth rate is incredibly difficult and arguably pretty unreliable.
So here's the classic analyst's dilemma, brilliantly illustrated. Because those cash flows are so wildly varied, valuing MTH strictly based on free cash flow yields that deeply pessimistic $29 target. But what if we switch our absolute valuation model to use earnings per share? If we anchor to their trailing 12-month net income of over $385 million, the implied intrinsic value shoots all the way up to $150.24. We're talking about a positive 57% margin of safety versus a negative 121%. It entirely depends on which input you prioritize. Moving to Section 3, let's explore some alternative absolute models like the dividend discount model and the residual income model to see if we can find some solid grounding. Let's start with the dividend discount model, or DDM. MTH pays a healthy dividend yield of 2.99%, supported by a super modest, highly sustainable payout ratio of just 32%. But here's the catch. Their 3-year dividend compound annual growth rate is a massive 52.39%. We obviously can't extrapolate 52% dividend growth out into perpetuity, so our explicit assumption here has to be a multi-stage DDM, one that accounts for this near-term explosive growth but eventually tapers off and normalizes over time.
But honestly, perhaps our most reliable absolute model here is the residual income model. When your DCF inputs are as noisy as MTH's cash flows, the residual income approach is fantastic because it bypasses all that noise. Instead of guessing future cash generation from scratch, it anchors heavily to the current book value of equity. It roots our valuation in accounting reality and only adds the present value of future earnings that exceed the cost of equity.
And speaking of accounting reality, MTH has a price-to-book ratio of 0.84. This is a vital piece of data. It means the market is currently valuing the equity at less than its accounting net asset value. For an asset-based valuation, or even a liquidation scenario, this 0.84 multiple implies that you're actually getting a significant built-in safety net. Basically, you're buying $1 of net assets for just 84 cents.
Okay, Section 4, the analyst's asterisk. We have to talk about limitations. A rigorous valuation requires total transparency, not just about the data you have, but the data you're missing.
We have to explicitly state that we cannot reliably apply the sum of the parts or the adjusted present value models here. An SOTP model requires granular, segment-level data to value different business lines independently. But our source documents only provide consolidated top-line and bottom-line metrics. Similarly, an APV model is great when debt levels are rapidly changing, so we can value tax shields separately. Here, we just have a relatively static snapshot of their leverage.
Therefore, following the golden rule of valuation, every assumption must be explicitly declared and briefly justified. We are relying on the absolute and relative models we've built. Where external peer data is absent from the filings, we're going to propose sensible workarounds rather than just blindly guessing.
Let's jump to Section 5, Relative Valuation. We've looked at MTH in a vacuum. Now let's contextualize it against the market to see what investors are actually willing to pay.
So here's our next explicit assumption. Because our source documents don't identify direct, external competitors, we can't just invent a basket of comparable companies without injecting outside bias. The elegant solution? We're evaluating MTH against its own historical 3-year and 5-year averages. This acts as a self-peer group, allowing us to measure whether the current valuation is stretched or compressed compared to its own historical norms.
And when you contextualize it against those historical averages, a really clear narrative pops out. MTH is currently trading at a significant premium to its historical earnings multiples. The current PE of 11.77 is nearly 40% higher than its 3-year average. Same story with enterprise value to EBITDA. It's sitting at 10.32, which is roughly 33% higher than its recent norm. On a purely relative basis, the market is pricing these earnings a lot hotter today than it has in the past.
But hold on, it's not all broadly expensive. Like we noted with that price-to-book variance, the balance sheet tells a completely different story. They boast an unbelievable current ratio of 11.31. To put that into perspective, anything over 1.5 is usually considered healthy. 11.31 means they have overwhelming short-term liquidity. An asset-based valuation shows there's just a ton of safety here.
On top of that, the debt-to-equity ratio sits at a super conservative 0.36. So despite the noisy cash flows and elevated earnings multiples, this management team is operating with an incredibly under-leveraged balance sheet. This gives them immense operational flexibility to weather downturns, keep funding that 52% dividend growth, or aggressively buy back shares.
All right, Section 6, the final analyst verdict. It's time to step back from the spreadsheets, pull all these quantitative threads together, and synthesize our intrinsic value summary.
Our valuation outputs create this massive, honestly fascinating implied range. On the downside, we have a bearish free cash flow floor of $29. Right in the middle, the current market price of $64. And way up on the upside, we have a highly bullish earnings per share ceiling of $150. So how on earth do we synthesize this?
Well, the key takeaway is that MTH's ultimate value hinges heavily on which metric you trust more. If you believe those highly volatile, capital-intensive free cash flows with their negative 21% CAGR represent the true economics of the business, then yeah, the stock is overvalued. But if you look at the steadily compounding earnings, that robust $385 million in trailing net income, the incredibly safe 0.84 price-to-book asset protection, and that growing dividend yield, well, the picture looks radically different. We've built the models, rigorously apply the absolute and relative methodologies, openly stated our limitations, and shown you the raw data behind the business. But in equity valuation, the final judgment is up to you. So, based on the evidence presented in this explainer, what do you believe is the true intrinsic value of Meritage Homes? Is it a value trap or a misunderstood earner quietly compounding its way to 150? Keep exploring the numbers, and thanks for joining me.